Most small business owners don't make tax mistakes because they're careless. They make them because the process hides problems until it's too late. And the tricky part? A lot of these mistakes happen while you're actively trying to do the right thing. If you're a small business owner, tax season usually starts with good intentions. You sit down to review your numbers. You open your tax software or organize files for your preparer. You tell yourself, I'm going to be careful this year. But then reality kicks in. You're still running your business. You're answering emails. You're juggling deadlines. And tax prep slowly turns from a thoughtful process into a task you just want finished. That's where these mistakes come from. Not from ignoring taxes, but from pressure, shortcuts, and assumptions made while filing. So let's walk through 6 common tax mistakes business owners make during tax season, and what to watch for before you hit the submit button. The first mistake I see a lot is filing with numbers that feel close enough. This usually starts with a quiet moment of hesitation. You're reviewing your reports, and something doesn't quite line up. An expense category feels higher than expected. Income looks slightly off from what you remember. But nothing is obviously broken. So you pause, and then you tell yourself, it's probably close enough. But here's the thing. Tax returns don't really have a close enough setting. Once you file, those numbers become official. They become part of your tax history, and they get compared to future years. Small inaccuracies don't always cause immediate problems, but they can quietly affect deductions, trends, and how clean your records look over time. And during tax season, when speed starts to matter more than precision, this mistake happens fast. Taking an extra moment to verify numbers before filing almost always saves more time than fixing things later. Now, when that pressure to move faster builds, it often leads directly to the next mistake, but in a slightly different form. Another mistake I see is changing how you report things, just to make it easier. After staring at numbers long enough, a very reasonable thought shows up. This would be simpler if I just streamlined it. So during filing, business owners make small, intentional adjustments, combining income streams that are usually reported separately, categorizing expenses differently than they normally would, leaving out detail because the total stays the same. And to be fair, this doesn't feel risky. You're not hiding anything. You're not doing anything dishonest. You're just trying to reduce friction. The problem is, tax reporting values consistency, more than convenience. When how you report things changes from year to year, it can create confusion later, especially if future filings don't match past patterns. Tax season isn't the best time to simplify your reporting structure. It's the time to reflect it accurately. And once things feel simplified and cleaner on the surface, it becomes very easy to lean too hard on the tools doing the work. The next mistake is assuming the software will catch everything. Tax software is helpful, and for many situations, it works really well. But it's also very literal. It only asks questions based on the information you enter. So during tax season, many business owners assume that, if something were required, the software would flag it. But software can't catch what it doesn't know exists. If income streams, platforms, contractors, or business activities aren't fully entered, the right questions never get triggered. This is how things like missing 1099s, platform income gaps, and overlooked forms can quietly slip through. The risk here isn't intentional. It's invisible. The software isn't double-checking your reality, it's reacting to the version of your business you entered. Now, even when the numbers are entered and the software looks happy, there's another layer many people overlook during filing. And that is, filing without attaching or confirming supporting documentation. This one doesn't show up as an error message. The return looks complete. The totals balance. Everything feels done, so you move on. What often gets missed during tax season is the backup behind the numbers. Receipts, mileage logs, expense summaries, reports that explain how you arrived at those totals. A tax return isn't just about the final numbers. It's about whether those numbers can be supported, if questions ever come up. Many business owners assume that they have the receipts somewhere. That should be fine. But somewhere and organized are very different things. Somewhere usually means that future me is going to hate this. When documentation isn't clearly tied to the return at filing time, reconstructing it later becomes much harder, especially months or years down the road. The goal during tax season isn't perfection. It's defensibility. Clear numbers backed by clear records. Now let's shift to a mistake that isn't about accuracy or documentation. It's about timing. Some small business owners files the tax return before seeing the full picture. This usually happens when tax season starts to feel like a race. You've received most of your documents. Most income is accounted for. Most expenses are in. So you think that this should be enough, and you file. Then, inevitably, something arrives late. A corrected 1099. An updated platform report. A missing expense summary. Tax documents have an impressive talent for showing up right after you hit submit. The issue here isn't impatience. It's sequencing. Filing before everything is finalized locks in decisions that might have looked different with complete information. Waiting just a bit longer can often prevent amendments, confusion, or unnecessary follow-up later. And all of these mistakes tend to stack up into one final, very important one. The last mistake I want to talk about is filing without a second set of qualified eyes when things feel complicated. This is the big one. While preparing your return, if you catch yourself thinking, I hope this is right, I'm not totally sure about this section, this feels more complicated than it should, that's usually the moment where self-review reaches its limit. Not because you've done anything wrong, but because complexity has increased. Most tax mistakes don't come from ignorance. They come from overload. A second set of qualified eyes can often spot the inconsistencies, missing requirements, and issues you didn't even realize. It doesn't mean that you have to redo everything, but to confirm that what you're filing actually makes sense. And during tax season, that confirmation can make all the difference. So if we step back for a moment, all 6 of these mistakes have something in common. They don't come from not caring. They come from pressure. During tax season, it's easy to accept numbers that feel close enough. Simplify reporting just to make things easier. Trust that the software has everything covered. Move forward without fully organizing documentation. File before every last piece is in. Or push through complexity without a second opinion. None of these feel reckless. They feel practical. But when they stack together, they quietly increase risk. The important thing to remember is this. Tax problems usually aren't caused by lack of effort. They're caused by decision overload in a short window of time. If a few of these sounded familiar, it doesn't mean you're behind or doing something wrong. It usually just means your business has reached a level where a professional review makes sense. Not as a panic move, but as risk reduction. A qualified CPA or enrolled agent can often catch issues, inconsistencies, or missing pieces before you file. For many business owners, the real value isn't even about saving money. It's about confidence. Knowing what you're filing actually reflects your business clearly, accurately, and defensibly. That peace of mind alone can make tax season feel a lot less like a gamble. If this was helpful, consider subscribing for simple and clear guidance on small business taxes and bookkeeping. See you in the next one.